Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
It's weekend time once again. We made it. No matter what you can read in the news, the world still didn't end. And we're still here. We're all still alive. So welcome you all back for another weekly market recap at the end of a week, which was, of course, volatile and particularly nervous in financial markets. The main protagonist, of course, if you want to identify the main theme, it's obviously the conflict in the Middle East, which is linked to a lot of different things from inflation expectations, the price of a barrel of oil, or the same availability of oil supply all around the globe. And then, you see treasuries selling off, yields spiking up, stocks starting to break key levels. So, if that wasn't enough, you still have the private credit crisis looming upon us, which, it might be a big thing, maybe not. Opinions are pretty much mixed up on that one. Maybe it is, maybe it's not, maybe it's that serious, maybe it's not that serious. But I think it's undeniable, which is another thing which is adding fuel to the fire of uncertainty and worries throughout financial markets. So let's start out with the economic calendar because we don't have a lot, or at least, I think the only one thing which is relevant would be this one, PPI, because again, it's linked to inflation expectations some way, all right? And all the rest, really, to me now, it's just taking the backseat, and everything is driven by what we see in these dynamics, which are linked to inflation, because then what the Fed will do about that? Is the Fed handcuffed at a point? So what should we expect in terms of, financial looseness or financial tightness? So I think this is the main driver for now. PPI, which came in above expectations, obviously, it came in at 0.7%. Which, it's a pretty high level considering the last 3 years. Now, I know people might say, okay, this is inflationary because if producers have to pay higher prices, they will be forced to pass it on the consumers. Therefore, you will have a higher CPI for the headline at the end of the day, which, mechanically and logically, I think, yeah, that would be true. The only one caveat would be, okay, let's see if they actually can pass it on to consumers, right? If consumers are tapped out enough and they say, yeah, thanks, but no thanks, I'm not going to accept these prices, I'm going to reject them. So what? Then the producers will have to eat the loss, right? Or, in other words, to absorb the inflationary dynamics. So we will see, it's kind of like what we were talking about with the tariffs. Who is really paying the tariffs? Are foreigners, so exporters, paying the tariffs? Really, the US government is collecting a lot of money from the outside, or, as it turned out, a few months later, US importers were actually paying the tariffs for the most part. We never talk in absolute terms, obviously. And so, a lot of different narratives could be debunked from one week to the next. But, this one, it's another one which is interesting to follow, and we will see how it's going to play out. So that's all we got, in my view. I think, again, everything else, it's a little bit secondary for now. And, I'm not even going to take a look at the others, at least at the beginning. We might check them out while we look at the charts. So it might be a bit more funny and easy to follow, right? So without further ado, let's jump into the charts. Having a look at these charts, as usual, we start out with the DXY. Pretty dull week for the DXY. We had that tiny little spike to the upside last week with a very strong close on Friday, and then the rest of the week was spent by drawing back the inefficient leg up. So for now, it looks like we are finding support at a previous level of a resistance, although very short term, but you see that was the swing which was responsible for the impulsive move down. Obviously, we found a little bit of resistance getting back into it. We broke above it, and now we are trying to retest it from the above and trying to confirm it as a support and resistance flip. we tapped almost into this old apex, which again, if you want to follow the same logic, it was the swing, the key swing high responsible for all these move lower. So again, pretty good area to expect resistance at. But, at the end of the day, at least for now, up until the point the structure doesn't break, which, could be something like this, could resemble something like this, right? So breaking this kind of a base right here and following back down. Up until that doesn't happen, you should still see it as, leg up, consolidation, leg up, consolidation, leg up, consolidation. What next? Another leg up? I mean, up until the point it doesn't change, it doesn't change. So it's like the trend is the trend until the end of the trend, right? So for now, I would maintain a slightly bullish bias on the DXY if anything doesn't change, right? Which again would fit what we are looking at in the broad market. Liquidity starting to be a bit lackluster, risk perception starting to go up. And what do you do when you perceive a lot of risk, or you have a lot of unfunded liabilities, or obligations which will come due and are denominated in a particular currency? You will try to hoard that currency because you need that. Also, if you see a lot of different commodities which are going up in prices, like oil, agricultural, what you're going to do? If they are priced in dollars, you will need to secure for yourself the dollars you need to then buy the commodities, which are really crucial to your overall well-being. So I think that's the main driver for the DXY going up for now. Sure, we are not seeing a massive spike, but just remember that, first, when something is going up very orderly like that, usually that's really strength, right? When instead you see the huge spikes, that's a little bit more on the weaker side, which is, usually prone to deeper pullbacks. So for now, I would still maintain that bullish bias on the DXY, which conversely, if you look at the other currencies, would mean being a little bit more bearish oriented on the euro, on the pound, not to mention the Japanese yen, of course. Canadian dollar is still there, still working on this apex. The base, I mean, if you look at this apex base, right, is it broken? Is it not? We closed slightly below it. We tried to retest it, and we kind of were rejected. So maybe it's broken. I think, with currencies, sometimes you tend to have a little bit of more of a erratic price action, but it looks like it could be broken, and we might see a bit more weakness, especially if the DXY will open next week strong enough, right? But again, all in all, I would say, although, I would be bullish oriented on the DXY and a little bit more bearish on foreign currencies, don't discard the fact that, we have seen sharp pullbacks, even in an overall trend, which could be down. And as you can see, even in here, we dropped the euro sharply, and then we spent almost a week pulling back. So, it doesn't have to happen all at once. These things, at least usually, they don't move. More than any other markets, they don't move in a straight line, right? So just be careful in differentiating your mid to long-term bias to what could happen based on short-term volatility, right? Again, it's not only about oil, about stocks, even currencies right now are responding to the news flows, right? So just, bear it in mind and pay attention to it. As for the rest, if we check, the Chinese yuan is pretty stable, and South African rand, it broke down and then, it retested, pulled back in the last low pre-breakdown. So this was the move which broke the trend, the flow of the market. That was the last structural low, which was defending this upside structure. We broke it, tested back into it, sharp rejection, and we are back facing this breakout tag before the breakout from this, medium-term consolidation, let's call it that, right? Brazilian real still holding the support, although, the more it tests it, the weaker it looks like. It's fine testing it once, bounces, no new highs, comes back into it again, another kind of an anemic bounce, and now we are back again at the same level. So we are, slowly but surely depleting all the liquidity on the buy side at this level. So how long could it hold? Don't know. I would just say the more we test it, the more we increase the odds that at a point it will just give in, right? Russian ruble was particularly volatile. I don't actually know what went on with Russia. Again, this one it's here just because it complements the BRICS basket, right? Russia, South Africa, China, India, Brazil. It's just for that. But I don't really follow Russian developments. I think we might have some volatility due to what's going on geopolitically again, because still we're talking commodities in the big picture. We're talking oil. We are talking nat gas. So Russia should be involved, and it may be reflected in the currency as well. But I honestly don't know, right? Indian rupee still collapsing, right? I guess again it's collapsing because it was already collapsing. It's not that this week changed something in particular. The trend was already established, and it's been established for a long, long time now, as you can see. But, I think they are suffering, kind of like, Europe, right? They're suffering the fact that they depend on energy commodities a lot. And if the price of commodities is going up globally, they will have to do what? To sell the rupees, to then buy the dollars, to then buy the commodities. So the local currency is going down against the dollar. It's not just that. I think that is just something which is exacerbating the overall problem. But, nonetheless, I think it could be something which makes the situation even worse than what it was already, right? Australian dollar still particularly resilient at these levels. Again, there is the usual theme. This is a commodity currency in the sense that since Australia exports a lot of hard commodities, if you want to buy them, you need to transact in what? Australian dollars. So you will need to swap your currency for Australian dollars in order to actually bid their commodities and guarantee your purchases. I was reading about China making pressure on Australia in order to convince them to accept payments in yuan. Who knows? That's another big theme when you talk about the big game, in the geopolitical sphere, and how much one side will be able to influence the other. I don't know if it's ever going to happen, but sure, that is in the plan of Chinese, right? Trying to convince the majority of people to accept their local currency for payments, with a caveat that it's, you don't have to buy Chinese government bonds. We are stockpiling on a lot of gold, so you could reinvest your surplus in our gold. Like, you give us back the yuan we gave you, and we give you back gold. So it's kind of like saying that our transactions could be kind of, at the end of the day, settled in gold, so that we kind of mitigate the problem of trading surpluses, right? But it's another one of those big game, big picture themes which is going around now. We are talking about the US against China. So, the US working on the Genius Act, China maybe trying to tackle the problem of the monetary system by defaulting back to gold. As, many gold bugs would argue, gold has always been money, and it will be, at a point, there will be the time where it will get back to be money again. So who knows, right? But, that might be another thing that you want to dig in your free time if you wish. I didn't, I didn't really go full on, but I just sometimes when I have free time, I like to indulge in these mental masturbations, right? I just find them funny, right? Let's have a look instead at Bitcoin. Now, again, if you remember last week, we were breaking out, we were trying to break out of this high, and it was already looking bullish. We held these base right in here that we were looking at in order to establish a support. We held it, pumped out of it, And then, if you remember, I said, well, look, all things considered, I'm still particularly neutral, right? And, it just turns out that, yeah, we tried again for the second, well, maybe even the third time, because 1, 2 times with this week right here, and now 3, we tried to escape this range, which was originated from, the sharp move, the bounce, and then you start to trade in this range. So we tried different times, both to the downside in here and in here to break out of it, and to the upside here, here, and here to break out of it. And then what? Then we always travel back again to the midpoint of the range. Here, 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 and again, mean reversion. Up again we go, and again, mean reversion. So this is why I was saying, well, at the end of the day, I'm feeling particularly neutral about Bitcoin, because I don't expect Bitcoin to really shine in a period where we are looking at a risk-off scenario. I mean, I think it's driven mainly by liquidity. So in a risk-off scenario, or in a, even if you don't want to see it at a full-on risk, as a full-on risk-off scenario, just picture it like this. Look, if you think about the price of energy going up, a lot of available liquidity, or a lot of disposable income, name it what you want, will be rerouted from, let's say in the real economy, would be from discretionary spending to that spending which is needed, right? And in financial markets might be, well, look, we need to buy the commodities that we need in order to keep the lights up or on, right? So who cares about the Bitcoin? That liquidity we have, we need to spend it the correct way if we want to keep on surviving. So, Bitcoin can wait for now. So that was kind of my logic. Which is why, sure, I mean, we were working, as we said, on the premise of higher highs, higher lows, which, that's not violated yet. But again, if you were looking at it from the standpoint of an ascending triangle, kind of like something like this, right? I mean, could you say that we tried to break out of this reaccumulation formation and we failed? So now that we are back at the same trend line, so what's going to be? Do we bounce once again and trying again higher? Or do we finally, we failed at breaking out to the upside. So what now if we break down, we break the trend line, we try to retest the area, and then we just go down? I know this squiggly line, it's not perfect, but yeah, when you zoom in, it becomes a bit messy, especially when you have Anchor, turned on. But, I'm kind of on the wait and see mode on Bitcoin. I think, if it drops from here, it's probably going to be something like I was discussing just in the middle of this week. I don't think we're going to see the flash from here. I would much more expect, Bitcoin price starting to stall a little bit, going sideways a little bit, showing weakness. And then at what point, if we have to see that drop, it would be impulsive from here, right? Something like this. But I would expect, if, again, a big if it has to drop, I think it's going to be stable a bit here ahead of times before finally giving in, right? So, these rejection at these levels, I was actually thinking it would have pushed a bit higher, maybe into the 76, 77, but, 76, lows, almost 76, what, 75, 995. Is it close enough? I mean, $1,000 more or less. It's kind of there, right? But again, don't try to split hairs. Is it a massive problem? Is the rejection was here instead of, let's say, in this region where I was expecting it? Well, maybe not. But nonetheless, the point was, look, I'm a little bit skeptical of this bounce, so don't try to join the rally in here, right? So I think that would be it for Bitcoin. And now we will transition in much more juicy stuff, all right? So let's have a look at what is really worrying the majority of people in markets, which is, of course, the price of oil. Now, we had the run up, right? We had the spike, the drawback, and then the market kept on reaccumulating. Now we are trading particularly stable in here, right? We are mainly forming a range. And it's kind of like, the way I see it, it's the market starting to think, well, then what? And what do I do? I mean, I got a lot of conflicting informations. You know, one day you tell me, and when I say you, I mean the Orange Man, obviously, you tell me that the war is almost over, the job is almost done, we are making huge progress, so maybe I drop a little bit. But then I see that you escalate the bombing campaign. Now, it's very recent news. I think it was yesterday or even this morning. I just briefly scrolled the news. It looks like they are preparing for boots on the ground, which again, it really, it's not a good thing if you think about a very quick resolution of this conflict. When you start to put boots on the ground, historically, I mean, I'm not that old, but for all the conflicts that I remember seeing, when you start to send people in, it's not something which could be resolved in a matter of days or weeks, right? We are starting to talk months, maybe, you know, so I don't know. I think the market is sniffing that. And that would be kind of like the reaction we're trying to reaccumulate. And maybe we could push again higher. Now, I think, you know, one other thing which we briefly touched upon it last week when we were talking about the prompt spread against the calendar spread. But another thing that we didn't touch upon, it's the difference in between the WTI price, so that was basically the US benchmark, against what's the global benchmark, so the Brent, which is basically based on what? The North Sea oil price, if I remember correctly. When you look at that spread, what you see is that for some reason, Brent is trading way higher than WTI. See, WTI closed the week around 98. The Brent is actually at 112, more or less. So again, that's there is a hell of a lot more premium in the Brent price rather than in the WTI. Now, one thing which could explain that could be maybe something like this, right? If you look at the production, I mean, these are staggering numbers. Like when people talk about, oh, well, but the oil shock of the 70s, you remember what happened when we got the oil embargo following the Yom Kippur War, and then we had the Gulf War against Saddam and all the rest. Yeah, sure. But back then, the US was importing a lot of oil from the Middle East. Right now, you just look at the sheer data, it looks like they are producing more than Saudi Arabia and Russia combined. Not to mention, when it comes down to nat gas, they are producing more than, I mean, as much as Russia, Iran, and China combined. So, you know, that might explain why when we talk about the price of oil, it's way lower in the US, because the perception might be, well, look, sure, we are going to be impacted. In fact, the price went up, sure. But maybe we're not going to be impacted as much as any other place around the globe. So Europe, China, India, right? So other nations which are dependent on oil, and they are all importing it, mainly from the Middle East, right? Like, I know there are other areas and regions of the world where you can actually extract oil. I mean, again, South America, somewhere, Venezuela. I wonder why they took it, right? But you know, that would explain the premium. It's just a risk perception. So what could be a shock in the US, whereas price goes up, sure. Am I going to be pleased by going at the pump and saying that I can now buy diesel for what, $5 a gallon? No, actually I'm going to be pissed, but not as pissed as my European fellows, which are probably at a point, if we keep on going like this, not only being squeezed at the pump, but maybe finding the pump shut down because there is not enough oil flowing in. Now, sure, this is a very pessimistic type of outlook. I'm just trying, you know, to go to extremes to emphasize the difference and to justify the difference in these two different prices. I'm not saying that I am expecting Europe to run out of oil next week, although, you know, it's kind of same as China. We have our reserves. It's just a matter of see how much we will be squeezed before everything is said and done. All right. Now, as for the rest, we were looking at the prompt spread. So if you, again, to reflect this situation, right, if you look at the prompt spread, so the contract up front against the following month contract, you looked at the spread, basically came back to zero. So this is the beginning of the war, and you see the spread going up in between the June contract, the April contract and the following month contract in the WTI. It went up and then it came back down. So, again, if you want to have some sort of a grasp of what the market is expecting, it looks like if the spread gets back down to almost being neutral, right, trending towards zero, collapsing, compressing, whatever you want to call it, it seems like the market is pricing in the possibility, again, not certainties, just possibilities and probabilities, that the war or the conflict may be resolved, in between 1 month or something, and we are going to get back to a little bit of normalization, right? But again, if you look at what the Brent spread is doing, the same spike to the upside, same drawback, and then it's going up, it's widening once again. So, I think again, this just goes to show that we have a much bigger problem globally than what the US may have. Now, again, this is not to say that I am completely pro-US, go ahead, do what you want, it's all fine and dandy. No, sure, I'm worried as anyone else, obviously, for very obvious reasons. I'm just trying to be objective and trying to analyze the data for what they are. And reality is that as much as you may say, well, sure, but the US just shooting themselves in the foot with this conflict because now they're going to pay the price and the economy may slip into a recession and the political capital of Donald Trump will be depleted. Yeah, those are all true statements in my view. But I still think in the big game of geopolitics, these energy supremacy type of strategy, whereas I don't really care if I'm going to suffer, as long as the rest of the world will suffer more than me, right? It's all a relative game at the end of the day. So, again, I think that's some sort of a strategy, if you wish. Is it a smart strategy? I don't know. I'm not smart enough to judge it. Is it a strategy which will work 100%? I don't know. Nobody can tell that, right? It's the good old saying goes, right? You never fight the wars you planned, right? Everything can happen throughout a war. Or, there are a lot of different cliches, right? Every war plan only survive up until you get to the first contact with your enemy, right? So, nobody knows. But at least what you could say is that there might be a strategy behind all of that. At least, when it comes down to hedging your energy risks. And again, as for the conflict, will it turn out to be a winner or a loser? Who knows? As I said last week, it depends on what you define as a win or a loss, right? Also, I do remember I was reading that Trump said we are thinking about de-escalating the conflict in the Middle East since the goals are pretty much all conquered at this point. We depleted their Navy, their Air Force, their missiles launchers. Yeah, but then on the other hand, you are preparing, 2,000-3,000 soldiers to put boots on the ground. So is it really over? Who knows, right? I'm no military strategist. I'm not pretending like I am. I'm just saying, I'm just trying to look at it from the perspective of the market. And, the market will react sometimes emotionally, sometimes knee-jerk reacting to the news stream that you have. So although I wouldn't advise to trade the news, it's undeniable that this market is very news-driven. So you at least, if you don't want to trade them, at least pay attention to them, right? Now, again, so that would be it for oil, but I think it's a way connected to what we are looking at in yields. And again, we are looking at yields going up, so from the 30-year to the 10-year and the 2-year. Now, if you notice, the 2-year, it's going up way faster than the 10-year and the long bond. So we are looking at a little bit of a flattener here, if you think about the yield curve, right? And, most interestingly, I think what we're looking at, I think the market, it's not necessarily reacting to really inflation expectations. Like, I don't think they're pricing in inflation per se. I think they're pricing in the Fed reaction to what's going on. And again, if you check what Powell said just this week when they got the FOMC press conference, he said that, the conflict is a problem. It could be a little bit of a pain in the ass for our progress on the inflation front. Sure. If you go in other places, like in Europe, the ECB is talking about hiking rates, which to me, it's just dementia at this point. But wouldn't be the first time. If you remember 2008, they actually hiked rates in July 2008. Just 3-4 months before the big crash. So they have a good historical precedent of making the bad decision at the worst possible time. So who knows? But look, at the end of the day, would you blame them? The only thing they can do is moving that lever of rates and the central bank balance sheet. So when you only have a hammer, everything looks like a nail, right? So I think that's what the market is pricing in. But now it's a good time to look at what's going on from look at the break evens, right? You see that, the 5 years, so kind of like the most, in between the two, obviously, but the most short-term type of inflation grasp we have, it's really going up. Like they're pricing it. Maybe, in the short term, you're going to have a hell of a lot more inflation. Okay. But the 10-year, it's not a lot. I mean, it's going up, sure, but not to the same degree. It doesn't have the same slope that you're looking at in the red line right here. And again, if you check the past, you remember, right? In here, the red line, 5-year, it went way ahead of itself, while the blue wasn't really following. And then what? We've seen these. They both converge to the downside. And, it was kind of the same in here. I remember we were discussing it. Whereas the red line was going up, the blue line not really responding to it. And then they both converged to the downside. Now, again, I think the implications are different. This time, you're not just dealing with economic dynamics, but there is a conflict involved, supply constraints in a major, if not fundamental, global commodities. So it could be a bit different this time around. But, don't discard the possibility that at a point we're going to see the same thing right here, right? As for the rest, if you check Trueflation, as for the headline CPI, still around 1.7, you might say, that there was a huge rebound. Sure, it was below 1%. Still, if you think about the headline CPI, which would still be at 2.4, I think. 2.4. It's right in front of my eyes, right? We are still way below it. So again, when instead you look at PCE, obviously that's way higher, right? So when you start to look around, it looks like we might have some sort of a potentially, hopefully, short-term inflationary pressures. But I guess again we will need to assess it as we go. All right. We were talking about central banks. Possibility of hikes, all of a sudden, it looks like the possibility of rate hikes actually was put on the board. Look at that. Very tiny, it's just 6%, but we have it on the board. Up until this point, we didn't. We were fully convinced that we were in a rate cutting cycle, and then all of a sudden, that's what you got. Again, it's just expectations. I think at the end of the day, they, at least, looking at history, maybe the Fed won't cut, and then they won't hike. They just take their favorite posture, which is wait and see, up until the point something breaks. If it breaks, well, I mean, I'm a bit more worried that a knee-jerk reaction could be taken in Europe or in the UK, the way I see it. I wouldn't expect the Fed to cut. I guess the one we saw was the last Powell press conference. we'll see if Kevin Warsh has the reputation of being an hawk. So will it get in the chair with an oil crisis on his hands, and he will decide to hike? I think even him will take a much cautious approach and go into the wait and see mode. But again, these are just speculations, of course, right? So, at the end of the day, yields are going up for now. I think a lot of that, there was oil, there was inflation expectations, but there was also another thing. I think, look at this, for instance, which are the main drivers of, inflation expectations when you start to think about the transmission mechanism, right? So, just read this paragraph. I'm not going to read it all, so I'm not going to waste your time. You can just pause the video and read it. But, there are three main functions which lead to higher inflation expectations, right? One, of course, the global or, regional conflicts where the US were involved, especially in the Middle East, which is an area which, impact energy commodities, obviously, when it comes down to their supply and supply availability, all right? Then you got oil prices, which obviously it's impacting inflation expectations as, reflected in the tips, because oil, energy is the economy and the price of energy is reflected all down, the manufacturing and supply chains, of course. And then inflation expectations. So sometimes it's not just about the real impacts, it's just what about people expect. Because look, if you expect to see higher prices tomorrow, what are you going to do today? You're going to go out and buy what you think you need today because you think it's going to be more expensive tomorrow. But by doing so, by changing your behavior, you become the catalyst for price themselves to be higher tomorrow, globally, if you look at the aggregate overall. So again, I think there is a little bit of that. Each of these components play a role. Look, and, if you want a chart of the three different components and see how they reacted all together since we had the start of the conflict, right? There is another thing. Look at these. We were talking about PPI. So again, when it comes down to inflation expectations, look, PPI was already going up. So, was it really the strike on Iran which brought inflation expectations higher, or they were just going higher again for their own reasons? Tariffs, because again, who's paying the tariffs, right? Doesn't look like the foreigners are, especially when you start to look at imports price, right? Why are they going up? If the foreigners are paying the tariffs, why imports prices are going up, right? So again. And then what? Then you had bonds being in a very overbought situation, right? Now, this is the TLT, I would believe. Yeah. And, if you look at some stupid Bollinger Bands, what you see is that we were touching in between the first and second standard deviation, right? And then what? And we just mean reverted back to the other direction, right? So again, I think there was a mispositioning, or, the proverbial people were all on the same side of the boat or on the bus. And of course, when it happens, something different than what you expect tend to happen. So we had a massive mean reversion. But, is it much different, right, from what we were looking at, I don't know, let's say in here, massively overbought, it came up. Then what? Massively overbought, came down. So it was oversold in here, overbought in here, right? And then it gravitated around, call it fair price, call it the mean, whatever. And then again, it stayed massively oversold for quite a bit of time. And then what? It went to the upside, the other direction. Most powerful force in financial markets, it's mean reversion. So again, see that? At the end of the day, bonds were overbought, therefore yields were oversold, as you can see in here, right? I think the market was just taken by surprise from this conflict, especially when we started to see that it wasn't just bombing and retaliation on military targets, but they started to target civilian energy infrastructure, like what we've seen this week in Qatar. I was reading, I mean, to some degree, I hope it's not confirmed, but most likely it should be confirmed. CEO of Qatar Energy, which is an energy company there, he said that the recent strikes of Iran on their net gas facilities basically destroyed 17% of their production capacity, and it will take them probably 5 years to repair that damage. So let it sink in for a minute. I mean, when the market sees that and all of a sudden you expect to transition from a situation where, yeah, maybe we will need to pay higher prices. Wait, maybe there will be not enough supply, let alone prices. We are starting to think about not being able to acquire that commodities at any price if there is not enough. So, will it be for real? It is just fear in the very short term, because at the end of the day, yeah, they shut down that percentage of production capacity. But what in the meantime, other producers would increase their capacity to just fill that gap. So nothing would change, from the standpoint of supply availability. So, I think, again, one thing is the reaction, one thing is the actual developments 2, 3, 4 weeks down the road. We'll see about that. And, look, if you want to have a little bit more of big picture type of a perspective, this is what happened historically, at least, if you just look at these episodes, well, which, fair enough, it goes back to World War II, right? This is what happened to treasuries, and they are taking the 10 years as a benchmark, of course, when the US started or, became involved in a massive conflict. So as you can see, more often than not, yields, right, just rise, right? They raise to higher levels. So look, I think this is another thing where you start to look around it and you see a lot of people being kind of in shock, right? Well, I would have expected the flight to safety type of dynamic where, it's a period of uncertainty, bonds are a safe haven, I'm going to buy those. Well, I mean, you would be surprised, right, by looking at this chart. In time of major conflicts, it looks like that doesn't really happen. And more often than not, it looks like the opposite is happening. So the false narrative of the flight to safety, when it comes down to conflicts, I'm not talking about monetary shocks, liquidity issues, and all the rest. I'm talking about geopolitical events in this case, right? So this is what you see at the end of the day, right? Which would throw a dent in a lot of different narratives, I do believe. So this is why I think bonds are currently going higher. To recap it, we've seen the data, we've seen the historical implications, we've seen inflation expectations. We know the market is trying to price in what, the Fed will do most likely, rather than long-term inflation implications, because, the long bond didn't really break things, still ranging, right? While instead the 2 years had a much more sharp spike to the upside. So I think it's going to be a matter of wait and see what's going to happen. My take would be, while we take a look at the bonds briefly, bonds futures collapsing, obviously. My take would be, look, it might be inflationary in the short term, but in order to determine whether you should expect sustained and prolonged inflationary pressures, what you need to assess is who's going to keep on bidding prices higher and higher in the real economy. Again, if you get to the point where you need to, rob Peter to pay Paul, right? Proverbial words. On aggregate, you're not going to have inflation. You're just going to reroute disposable income to what you would like, discretionary, to what you need. So you might see price of energy and other stuff like agricultural being higher, and maybe you don't have enough money to buy that things you need, plus keeping on having vacations, traveling, buy a new watch, buy a new pair of jeans, buy new sunglasses, buy a new car, leisure and hospitalities and all the rest. So maybe you will see prices going up in a few sectors and being massively down in others, which at the end of the day, if you think about the headline CPI, net, they might net out. And you're not going to see CPI creeping back up to 5, 6, 7%. This is my base case for now. So maybe CPI will go from 2.4 back up to 3, 3.2, 3.4, but it's not gonna last. People are always afraid about stagflation. The problem I see with that is that I don't see a lasting situation, when you can have inflation and at the same time unemployment going up and the economy contracting. Those two things, they don't go hand in hand. If the economy is contracting and people are losing their job and GDP goes down, inflation would follow. It's just the way it is. Remember, what are rates at the end of the day? Rates are just what? A reflection of future growth and inflation expectations. If you don't have growth, it's hard to have inflation. Therefore, rates, when it's all said and done and enough damage has been done, rates should again mean revert back down, right? So, long parentheses on rates and oil, I get it, but these are the things which are keeping the market awake at night for now, right? Now, let's have a look instead at, what we got next. Metals. All right, metals. So, obviously, not a very good week for metals, let alone, the month so far. So you see futures on silver from the peak, they are now down 44%. Platinum, they are down 34. Palladium, they are down 35. Copper, down 20%. So again, this is another thing, spoiler alert, it's kind of the same with gold. This is another thing which left people a bit shocked. How can it be that in time of a major conflict, which could potentially send the world in a global recession, or it could escalate in, again, World War III if other nations start to get involved, the mainstream media, they like to talk about those tailed risks in order to sell or to entice you to click on an article. But again, let alone this for a second. But why in periods like that, when the perception starts to be kind of like that and the narrative starts to move in that direction, you would see precious metals going down, right? Look, I think, again, people talk about, what was the word? Refuge type of asset. Are they historically? Because I don't think they are necessarily. But for instance, look, I think, I know I'm sorry, gold bucks, but this is going to sound extreme to you. I think gold, let's take just the king of the metals. I think gold is a risk-on asset. Gold is a speculative asset. It's not a refugee, right? Look, take gold and take for contrast, a US Treasury bond or a 10-year note. When I put my money in a 10-year note, I do know how much I'm putting in now, how much I'm going to have back in 10 years, right? And the yield I'm going to have on that. So by the moment I put money in, I can do the math and actually calculate what I'm going to have back. So my point when I put money into treasuries is not necessarily the return on capital, it's the return of capital, right? Because again, it might be that, maybe I'm not really gonna win against inflation if real yields are lower, right? That means that my returns are on bonds are not gonna be that much, so I'm gonna lose against inflation. Sure. But the capital will return, right? While instead, if I put my money in gold, I don't get a yield, and the only distinction in between me making money or losing money, it's the price appreciation or depreciation. So what is that? Isn't it a speculative bet? Can you do the math on that ahead of time? No. So how can you say it's a safe haven place where still you have some sort of uncertainty component? It's not. You're playing the odds. You're playing a narrative. You're placing a bet. which makes it what? Speculation. So gold is what? Speculative asset. And all speculative assets are what? Risk-on assets. You're taking a risk, right? And again, there are times where it goes well, there are times where it doesn't go well, right? So, this is what we're looking at. Technically, what we've seen again, we've seen the bounce, as discussed last week. There was a drop. And then look, I'm going to take silver as an example. We got back into this apex right here, which might be more evident on the 4-hour. Yeah, sure it is. There you go, right? And down we went, right? Let's get back on the daily time frame. Same for the others, right? Bounce, faded, tiny little pullback, down we go. It's the same across the board. No matter, do you remember the narratives? Oh, there is a huge demand for physical silver and there is not enough supply in the vault. Yeah, sure. And then, yet it's plunging. It's down 40%, 45 almost. What about all the demand for physical silver? There's not enough silver. It should skyrocket it. I mean, you can throw at it whatever conspiracy theories you want. Like, they are trying to artificially suppress the price of metals. Otherwise, the banks would go bust. And the banks had all those huge short positions against the metals. If they don't tame the price, they're going to break the financial markets. And then, sure. But at the end of the day, it's just following the same pattern it followed many other times in the past. And, especially about silver, if you go back to my videos from starting from the end of December, I kind of told you the potential scenario for these metals. Now, does it mean that long term, like in another 6 months, 1 year, whatever does it mean that silver will keep on just going down and down and down, same as the rest? Not necessarily, right? I'm just saying, and I was just saying, be very careful when you see a market going way ahead of itself like this. All of these, they went way ahead of themselves. Because usually what we got after that, in the aftermath, is first, a lot of volatility, again, and if you keep on trying to buy every single dip, especially people using leverage, look, pray the gods because you're going to need a lot of luck in order to be successful at it. And, the only way you could manage risk is just taking profits, trim down your positions if you are into profits, right? And then reevaluate the situation. So this is what happened to metals. And of course, this is what happened to gold. At least, we're looking at the futures, remember, we're not necessarily looking at spot price, but 20% down. Look, do you remember what we were discussing about these bays right in here, right? What do we say? We tried to get back to the highs. We were rejected. Back to base or last available base, untouched, untested base, unmitigated base, whatever. It depends on your favorite YouTube influencer at this point. Anemic bounce, down again, second time, another bounce, and then you fade it. What do you think is going to happen after that if we come back down into it? You remember? Third time, is this the charm? It doesn't look like it. We break it, and once we break it, we basically targeted all the tiny, you could, again, it depends what type of framework you have, but you could say, well, it was a huge stop run on all these people trying to buy the dip, convinced that we are still in a bull market. Is it? Maybe, maybe not. To me, the way I like to see it, it's not necessarily, they're trying to hunt your stop. They see where you place your stop. Well, not necessarily. I just think all that liquidity to the downside was already picked up, right? And then, when the momentum to the upside breaks, all the inventory at these levels was already picked up. There is not enough fresh inventory to hold price up, which is why you see a very impulsive move down to where? The last time we actually found a bit of inventory, where was it? In here. So we are back into it again. So again, same logic applies on a much different scale, but it's the same, right? Look, 1, 2, it's the third one, the charm? No. 1, we are now at 2. Can we bounce from here? I would say there is a good possibility we bounce to rebalance a little bit of this inefficient move down, sure. And then, after that, we reassess what's going to happen. Are we working on some sort of a double bottom? Are we trying to establish some sort of a long-term type of consolidation at these levels? Maybe, who knows? Again, if you remember, I was saying the most bullish case for gold for me would have been a very long-term consolidation. Honestly, although we may bounce, I wouldn't be surprised if we bounce, I think we still have space to drop a bit lower. I would say around here, 4,250. That would be a level I would like to see retested at a point. Not saying we have to go there, but I would like to see this one retested, and I don't know, for some reason, a bounce from this area would be much better for me rather than a bounce from this one, right? But again, we'll see. Sure, when you talk about gold and metals, you still have to talk about what? I know we hinted at that in the past. I'm gonna try to keep it short, but again, I think it's linked with yields, which obviously they are influenced currently by oil. So I think it just fits the entire narrative together right now at the current moment in time. So let's have a look at these. Now, I mean, if you have followed me for a while, you already know what I think about, the basement trade, the war de-dollarizing itself, all the, yeah, sure. Look, so real briefly, here you see foreign holding of US Treasuries, they kept on going higher, even in 2025. Now, look, the difference, as you can notice, is that there is an increase in the orange component of the bar, which is what? Private foreigner, right? So funds, banks, and all the rest. There is a decrease over time in the blue component of the bar, which is what? Central banks, okay? Or sovereign states, or sovereign wealth funds, or whatever you want to name it. Okay, so look, this is one thing. The composition is changing in aggregate. Anyway, there are people abroad which are willing to buy those bonds. So first of all, that's it. Now then, go ahead. What you see is that, they also, even if you look at Japan, UK, China, pretty much compared to 2024, all of them increased their holdings. All right. If not China. But again, we went over this topic a few weeks back. What's happening with the yellow line, which is China holdings going down, and then you look at an orange line in here or a purple line in here going up. And we said that is China still buying treasuries, but changing the ownership or the custody of them. They're buying using Belgium and Luxembourg as a proxy, right? Therefore, when you adjust the China holdings, it's pretty much flat. It's just the jurisdiction which is changing. They are still buying treasuries. They prefer to hold those treasuries or buying them via proxies in Belgium and Luxembourg for a lot of different reasons, which we'll have a look at the end of it. Again, if you look, right, at those two lines, when you adjust for those dynamics, what you see is China is pretty flat. So they're not really divorcing from treasuries. They're not increasing them, but yeah, still, it looks to be pretty steady for now. And then what? Then you got these. The other side of the spectrum, right? A lot of central banks are increasing their gold reserves. And if you look over the last 20 years, it looks like it really accelerated since what? Since when we had the West freezing and seizing Russian assets. Okay. So, although you might see that over the last 20 years, there was a huge net change because, and remember, I like this chart because in here, we are not talking about the dollar value of the reserves, but we are looking at the tons, so the actual quantity, which is for me, it's way better, all right? So that you get rid of those, biases which could come to you from just looking at something which is influenced by the price variation, right? So they increased like a lot, but the majority of that increase came in over the last 3-4 years. So there was an acceleration which was driven by what? Monetary dynamics? Economic dynamics? No, it was just geopolitics, right? So it's more of a geopolitical risk rather than, a shift in the preference from a perspective of, financial markets, monetary matters, and all the rest, right? So again, this is particularly crucial, I think, if you want to have a big picture. And then what? Again, you see that the net purchases of gold, they started to ramp up after 2022. Again, it fits well with this chart. Russian conflict and Russian assets seized, all right? As you can see right now, still, they are, the foreigners, central banks, yeah, sure, they increased a lot their holdings of gold, but nonetheless, if you combine the treasury holdings and if you combine the private foreign treasury holdings, they are still the majority of the basket, all right? All of these to say what? And again, I'm going to apologize, but I'm not going to read the entire thing, but you can read it for yourself. Bottom line is, what you're seeing is that although you may think that someone is ditching the dollar and favoring gold, at the end of the day, when you think about the fact that in major exchanges, gold is still priced, traded, and settled in US dollars, at the end of the day, you are still using gold as a proxy for the dollar, right? Just read this paragraph right here and you can see how the price of gold is determined pretty much globally, right? The problem with that is, again, that you're not shifting your reserves composition in order to manifest a different preference, aka I don't like dollars anymore, or I don't like treasuries anymore. No, you're shifting it in order to diversify your risk, all right? But still, what do you think you're going to have if you are forced, for whatever reason, to sell your gold reserves? Are you going to be paid in what? Indian rupee? Euros? Japanese yen? No, you're going to be paid in dollars. Now, sure, then you can use the dollars to do whatever the fuck, but still, you get the gold because still you know it's priced in dollars. The only difference is that gold, if you have gold in the vault, the US or the West, as it is, like Europe, they cannot seize it by the click of a button. So you are taking the same benefits because still you can sell the gold for the dollars if you need them, but you're not taking the chance of seeing your reserves being seized by a foreign actor in case geopolitical tensions could escalate. All right? So it's not a matter of gold versus the dollar. It's just gold versus treasuries. It's that type of rotation which is used not because you don't want the dollar, not because you want to divorce from the dollar system. You just want that those in control of the dollar system, they should have way less leverage on you and therefore way less counterparty risk. But you still want to use the system. You just don't want to be that much at the mercy of someone which could control it. Now, you might argue, well, in the long term, there is an incentive for the rest of the world to come up with alternatives to the dollar system. Sure, that's absolutely true. And they are trying. It's not to say they're not. And you look at the different type of experiments when it comes down to transaction system, to payment transfer system, what you've seen in China, in Russia, bilateral agreements and all the rest. But the BRICS, right? But at the end of the day, still, it looks like there is nothing so far which is good enough, which could scale well enough, which is creating some sort of an agreement widespread enough to replace the system we have, all right? And then what? Look, these are the 5 main themes, again, if you want to read them. So it's about, again, cost to demigration, not asset flight. So there is a changing in the composition of who is holding the treasuries, so official against private actors, right? Then what you got? We talked about that. We talked about point 4. Oh, regulatory fragmentation. If you think about the regulatory risk that you have, especially what is going on now in the US, where, what was that point? He was saying it was self-inflicted. I think it is here, right? Yeah, mandatory clearing, capital charges, transparency requirements are pushing treasury markets activity offshore. Why? Well, because it's becoming too complicated to make deals in your jurisdiction. And I get the feeling that you want to put your hands in my cookie jar, right? So what I'm going to do, I'm going to move those balance sheets as well when you don't have jurisdiction, but still I'm going to use the instruments, right? And again, it's not a decision that the rest of the world is taking, but they are pushed toward it by what? By the US regulations. So, again, a lot of different things, a lot of moving parts, but still, if you just believe, you can't just sit there and thinking that the rest of the world, all of a sudden, it's just stitching the dollar without a viable alternative. It may come at a point, maybe 5 years, 10, 20, 50 years, who knows? Just don't be misled by, again, I don't hate the man, but fucking, have you ever heard, or have you ever listened for more than 30 minutes of a Peter Schiff podcast? At this point, I'm watching it for a laugh, but it just, look, the guy may be right. A problem, again, for me is, you might be right in another, 30 years. Who cares? I'm going to be 80 at this point. I'm not going to care, right? Or I'm going to be dead in 30, 40 years. Who knows, right? So you need to trade the market which you have in front of you, not the market that you think it might be in another 20 years, right? Unless, of course, we're talking about, I know people say invest for the long term. Yeah, sure, go ahead with that. And let's see how gold reacts in times like these. Oh, shit. I mean, real rates are actually going up. And what? I mean, and gold is responding like that? Sure, why not? That's how it's supposed to work. Because if real rates are going up, that means that a treasury is much more attractive for the same type of logic we were discussing before. Because a treasury, it's really a flight to safety to some degree. Gold is not. Gold is a speculative asset. So that's what we could say about that. Another thing that could throw a dent in this inflationary theme, and therefore you should go and buy gold, go out and buy gold as if there is no tomorrow. Look at that. People always point at this. And in blue, what you see is M2 money supply, which obviously is going up. It's going up forever. Right? If you get back to the 60s, right? Always went up. You know what is another thing which is going up in red? It's US GDP. So as you can see, in our current system, if you have growth, that growth needs to come with an expansion of the monetary supply. Most of it, usually, or historically, up until recent times, I get it, was driven by private commercial banks' balance sheet expansions, aka their willingness to extend credit, right? Now, sure, you get to 2020, you see there is a massive Fed intervention, massive stimulus, and I get people saying, well, look, 45% of the current currency units in circulation when it comes down to the dollar, they have been, quote unquote, printed. Actually, in this case, since we're talking about the government, we could say printed in this iteration in the last 4 years. Sure. And then what? Like, I mean, if you start to look at these, right? They printed a lot of money in here, 2020, sure. What happened to GDP in 2020? As you can see, GDP collapses. And I know that scale really doesn't make it justice. Let's see if we can do it like this. Can we? I guess we can't. Well, it would have been a hell of a lot better, but it's still the same. We are just looking at them inverted. But look, GDP starts to go down, right? And I know it doesn't look like a lot if you look at this scale for the chart, but it goes down. So you have what? Contraction. And at the same time, when you have contraction, you have a massive monetary expansion. So what do you think is gonna happen? inflation goes up because the monetary supply is growing much faster than the economic output. So you're not producing enough stuff, enough goods and services, but at the same time, you are putting in circulation way more money, which are now competing to way less goods and services. It's just supply and demand. What you're going to think is going to happen? Prices will go up. And sure as hell, CPI went from basically less than 1% up to 9%. Up until the point something happened, which is the inverse. You see that monetary supply expansion starts to tame down a notch, but GDP keeps on growing higher and higher and higher. Therefore, inverse phenomenon, you have disinflation. Because now we have more goods and services being available in the real economy to be purchased and less money chasing them, right? So again, it is true, if you want to hear to the gold box, that a lot of money have been printed, but you never think about how much the economy grew. Now, do I think this is the best system we could have? No. No, absolutely. But under many different perspectives, this system, it's just a shit show, especially when you don't have free market capitalism, but you have a crony capitalism system. But nonetheless, even in a system which is bugged, which has a lot of flaws, which brings to some phenomenon like the K-shaped economy, still, you need to look at the numbers, and you need to look at the data and the dynamics at play, and recognize that sometimes narratives are one thing, reality might be completely different. So again, it might be another thing where, you want to pay attention to, right? So to speak. Now, enough of that. Let's have the usual, this time around, secondary pose, and then we're going to transition to stock and wrap up the video for the week. All right. Not a lot to say about stocks. I mean, they started out the week by shooting higher, right? So Monday, Tuesday, it was all to the upside. And then, of course, on Wednesday, we got the reversal, right? And we kept on dropping quite impulsively, I must say, throughout all of Wednesday. Thursday, kind of the same. A little bit of a pullback, a tiny little bounce. And then on Friday, down we go again. So at the end of the day, if you look at that, it's just bounce, down we go. It's much more evident if you look at the daily time frame, which is basically feeling the path that we were expecting last week at the close, right? We opened up the week, pulled back, right? And then down we went. So it's kind of the same all across the board. We pulled back in what? Here for NQ futures, here for ES futures. Kind of the same here for the Dow, and basically in here for the Russell. So basically all the points of release which were leading to the move to the downside. All right. Now look, I think the most important thing for this week is that we did close below the 200 days moving average. And we're looking at futures. So, as we were discussing last week, how many times can he hold if we keep on pushing into it? It looks like we gave in. Now, the problem now, same as we were saying last week, next week we could do very much the same. So basically opening, coming back up, maybe, as we did previous week, maybe testing back into these freshly broken 200 days moving average, and then, watch the reaction there. I would expect, maybe first test, we are going to find a bit of resistance there. All the other moving averages are indicating momentum increasing to the downside because they're all sloped to the downside. And the delta in between them, it's actually spreading, so it's widening. So it indicates momentum. But, it also indicates when you are, far away enough from moving averages, since they are averages, as we've seen in the past, don't discard a pullback into them. It could be a pullback to the yellow, could be a pullback to the blue. So, just don't start the week with the absolute certainty that as soon as the market opens on a Sunday night, you need to sell everything you have, right? Just pay attention. because as we've seen, these market for now has been particularly choppy, although it was going down. It looks, sadly, that we broke now the support for ES futures, kind of the same support for NASDAQ futures, kind of like in here, we closed below. So again, whether you want to look at moving averages or horizontal lines, would you expect, same as we did before, a little bit of a maybe bearish retest, confirming it, support or resistance flip, right? Again, something like this, maybe, who knows how many days. It could be all done on Monday, or, you know, it could take the entire week, depending how the market wants to trade. It could be sharply, it could be choppy, who knows? But I'm just saying, don't think that just because we close below a major support, we are just going down and down again for eternity without any type of pullback. So don't discard that. Especially because, I mean, if you look at momentum indicators like stochastic, it starts to be in oversold territories. Same for the MACD, right? So, you know, always pay attention to mean reversion, all right? So, other than that, I don't think I have a lot to say about the stock market. Like, you know, one thing you could do if you really want to, just for the, I know at this point it's just hindsight, but if you look at what happened throughout this run up, right? So let's just try to put some sort of a volume. I mean, is it correct? Yeah. So the majority of the volumes happened in this range, if you look at ES futures, basically. So point is now, every single time we may come back testing into it, what we're going to find is trapped longs. All those people which were buying in here will see every single rally attempt as an opportunity to the risk, which is why, you know, yeah, you might have your pullbacks, but it might also be that they're gonna be sold into, right? So this is the only one thing I would say for the stock market when it comes down to the technicals. Other than that, I don't think there is really a lot. A few stats, if you wish, since we took out the December low, the previous December low, so 2025, I don't know how much it's gonna come up on the recording, but these are a few stats on what happens after, you know, in Q1 and for the full year after we take out the December low, the previous December low. Another interesting stat, it's what happens when we take out the 200 days moving average. So after 1 month, after 3 months, after 6, 9, 12, 24. So as you can see, all things considered, usually, you know, you could estimate from 3 to 6 months to see the market getting back to actually show gains for the period, for the year, maybe. After 9 months, sure, majority of the times, you see many different occasions when that happened, right? After that, it takes the market a while to get back, you know, to new, not alone new highs, but just being positive for the year, right? So it might be something which could orient your bias, especially if you're playing for the long term, right? And anyway, even if you are trading short term, it could give you a little bit of a perspective or framework on what you would like to do and what type of trades you would like to favor in this environment, right? Another thing might be this. It looks like, you know, we are seeing credit spreads still creeping higher a little bit, and credit default swaps, again, if you consider this range, they are at the high side of the range, which, again, credit spreads, do I have it? Yeah, again, see, they are creeping higher. Look, historically, obviously, they are still pretty low, right? But nonetheless, they are starting to signal maybe a bit of stress in the credit markets. So yeah, just keep on monitoring them. Other than that, on the good side of the equation, if you want to look at the news, you might say that we have a nice surge in short ETFs volumes, which means usually, again, when all of the people are short, right, what's going to happen next? It just take a tiny little bounce to take out or to liquidate late shorters, right, people which are late to the party, and we might originate a much bigger bounce than what you could expect, which in an environment like this, as I said, where the market is not really plunging, but still it still looks like a distribution, very ordered, very messy, very slow, very choppy, but still, in a context like this, if you have a lot of shorts which all of a sudden needs to close and they are punished, you might see a sharp pullback to the upside. So again, it's a difficult market, right? And although this might be seen on the positive side, it is also adding, difficulties in reading the market, in deciding whether you want to do what, buying or using those bounds to establish edges to your long-term, long-only portfolio. You want to go short the market, but if you increase the volatility because a lot of people are already short, you might try to get short, and then you find out that the bounce is way bigger than what you were expecting. You end up being liquidated on your short, and then you see the market collapsing after it took you out. So it adds volatility in my view, right? So pay attention to it and be nimble. Still, stock market compare against the 30 major geopolitical events since the 40s, basically. What you see, and again, this might be seen as a silver line there, but it looks like if you check historically what was the progression of the stock market trend throughout these 30 geopolitical events, it looks like we are almost in line with that, and we are kind of, standing to this, reaching the trough. And from here on out, it might take another, 2 weeks, maybe a month, but we should get back on track and, kind of rebounding and all the rest. Will it play out like this just because it did in the past? Absolutely no guarantee. It's just another one of those stats which you might want to take a look at if you want to track it. I think the main message is that oftentimes the moment where people are panicking the most and starting to talk about the end of the war, major war escalations, major disruptions, oftentimes historically those were the moments where really the market was turning around because everyone was really feeling the max pain. The sentiment was the most bearish it could possibly be. So, there is a narrative to be built up in order for the market to actually finding its footing in the next, let's call it a month, and starting to get out of the woods. Maybe, who knows? There are many different things which are still moving around to make such a call. But, if you are a stat nerd, you might want to keep on monitoring this one. Other than that, we got sentiment, which in between individual investors, it's the most bearish ever, or at least, over the last few months. So again, this is usually a counter trend signal. It should, but very conditional, signal the possibility of a bounce, which in this context, again, wouldn't be surprising. All right. And even in between managers, right? So if you look at their exposures, it dropped like a lot. Usually when managers are really dropping and selling and liquidating, those are historically very good, at least short-term bottom signals. We will see. Again, it's just a matter of probabilities. It's not strictly a matter of having a crystal ball. Take in as many different informations as you can and then come up with your own case, right? I'm not here to say this is going to happen, that is going to happen. I don't know. I'm just trying to assess the odds of one thing happening over the other, and especially trying to come up with levels, points on the chart, developments in the news stream where I do know that the bias I had for the week or for the month, it's nullified, and I need to get back to a much more neutral type of bias, or, God forbid, inverting it all the way up. So, that might be it. Finally, at the end of the day, we are all trading oil. Whatever we are trading oil. This is basically the stock market against the crude oil chart inverted. As you can see, they are pretty much inversely correlated for now. And then, of course, if you invert one of the two charts, they're going to look like they're tracking each other. But since one is inverted, it means that we are looking at in reverse negative correlation, right? So this is it. Now, again, last brief point about, we hinted at that private credit. I briefly hinted at that in the past. Last 2-3 weeks, I think, we have been talking about Blue Owl. We have been talking about UBS fund. We have been talking about the other fund in the UK, MFS. Was it? I mean, it was a British fund, right? Fund which was shut down again. So just as a recap, again, not going to read it all. You can just pause the video and read it. So this is the definition of what private credit is. If you just want to have a 10,000 feet level type of view on the whole, right? And these are the benefits and the risks which are implied in, being involved in private credit, right? So, pick your poison. If you feel like it, sure, why not? If you don't feel like it, well, maybe reconsider, all right? And then what we got is, again, what people are talking about, as I was hinting at in the beginning. Is it like 2008? Is it not? Look, there are similarities, right? But there are also differences. My take on it would be that at the current moment in time, no, it's not like 2008, or there is not the same degree of risk, because the balance sheets which would be at risk in the case that these things really go south would be private balance sheets. We are not talking about putting at risk every single American household balance sheet or banking account, right? So the scale is much smaller in this case, up until the point, keyword, because you don't really know, and you can't know, you don't have the ability to know the ramifications and the different intersections that we got in between all these different entities' balance sheets, right? You might say, sure, banks are safe. They learned their lesson in 2008, and they have structured their balance sheets in a way which, will keep them safe for something similar happening again. Okay, sure, they still have a bit of exposure, because who is providing the lending to all these entities like Blue Owl or Apollo or whoever, which are then providing the lending to the private entities? So some sort of a subprime dynamic still the banks. So if the original borrower is insolvent, then the shadow bank, or the Blue Owl of this case, it's insolvent, and then the bank needs to take it on the chin, and it's impacting on its own balance sheet. All right. But point for me would be the structure that is being created in between these private credit entities, which started to absorb insurance companies, so that they created some sort of a circular type of loop. It's kind of like what we've seen with the AI financing, right? We struck a deal. I give you the money, but you commit to buy a lot of my products. So these are just money going back and forth. I think in private credit, we are looking we are discovering that something similar is happening. Like I am a private credit fund or entities or manager, right? What I do, I acquire an insurance company so that then we are on the same boat. I can put my hands on the insurance company's fund or the pension fund's money and pour them in my private credit deals that I got here, right? And then, if those deals are good, a good chunk of the profits will circle back to the pension funds, which is still mine, right? So, I think there is a little bit of a component of it in the whole. I'm not going to spend another 20 minutes trying to dig into it, but just, I like to give these hints, and then you can do what you want. And I, again, I think to close up, at the end of the day, it's still a matter of seeing how much contagion risk you would assess to the entire topic. And, if it gets bigger enough that it starts to impact many different actors, at a point, I would think someone would step in, the Fed. By what? Cutting rate. No, inflation, energy prices, you cannot cut. Look, if we start to see contagions, and at the end of the day, I'm wrong, and they think it is actually way bigger than what it looks like from a surface level right now, and we might take the chance of a financial freeze, you better believe the Fed will do something. they did it. Do you remember what happened in 1998 when LTCM, long-term capital management, really took the chance of blowing up and pulling down the entire Wall Street? But they cut rates, even if there wasn't any type of cover when it came down to the labor market or inflation risk. But they cut anyway, because the central bank at the end of the day has a dual mandate. Stable prices and full employment. You know what's the most important hidden and not spoken mandate? Make sure that the financial plumbings are still functioning and we are not freezing the entire system, because otherwise say goodbye to all the rest, right? So, a few considerations on the private credit type of dynamics in here. Now, sorry, at this point it's going to be a long video, but anyway, there were a lot of things I want to hint at. And as you can see, just hints. Not deep dive. You are free to do it yourself. At this point, I'm going to leave you off, calling the week, wishing you a very good rest of your weekend. And remember, next week, it's always an unknown. So keep on being nimble, keep on being very, very sharp, and don't need you to react. But at the end of the day, manage your risk, right? With that being said, be nice and be cool. Niels out.
Mm-hmm. 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 Come on. Mm-hmm.